Hello, everybody. This is Hugh Johnson. I'm the chairman of Hugh Johnson Advisors, and I want to welcome you back to our Market Minute to give you a little bit of an update on what we see going on in the obviously the financial markets, which are dear to our hearts, important to us all, as well as the economy. It's the most important question which faces us as investors. Is clearly that are we at or even near the end of the current cycle, a cycle which consists of three parts: a stock market cycle followed by or accompanied by a economic cycle accompanied by an interest rate cycle. And this is an important question now, particularly in a timely question because we're at the 122-month mark of this bull market, which makes it the longest bull market in our financial market history. So that alone tells you we've got to really be on our toes, looking for those signs or signals, both from the financial markets as well as the economic variables, that tells us that we're at the end of the current cycle. And if we are at the end of the current cycle, then we've got to take steps to obviously preserve capital, to defend portfolios. So that's the real question. And to answer that question, we look pretty carefully at the performance of the financial markets, because the markets perform in very specific ways at the beginning, middle, and the end of a cycle. And we look very importantly at the monetary and economic variables to see if indeed the monetary and economic variables are also confirming or signaling that we may be at the end of the cycle. You know, one of the reasons why we responded to financial market performance in the fourth quarter was indeed because it looked as though in the fourth quarter the markets were sending us a signal that we might be at the end of the cycle. The reason we did not reduce equities more, or our exposure to equities more than we might ordinarily do was primarily because the message of the financial markets in the fourth quarter was not confirmed by the performance of monetary and economic variables, particularly when we look at such things as the index of leading economic indicators. I underline the word leading because it tends to lead the economy and tell us whether the economy is going to continue to expand or not. And that index of leading economic indicators, as well as many of the variables in that index, told us that, look, the financial markets are performing very poorly, particularly the equity markets performing very poorly. But indeed, the economic variables are not performing very poorly, are not confirming that we are at the end of a cycle. That's why we reduced our exposure to equities some, but we did not reduce our exposure to equities all the way. We did not take those extremely strong steps to try to defend portfolios. And it turns out that we were right. And it turns out that that was only a very significant correction in an ongoing bull market. A correction, I might add, if you look at all the details, like the length of that correction between September and December, you look at the magnitude, 19.4%, it was very average by standards going back to 1890. It looked like the so-called normal correction, and certainly not the start of a bear market that would be followed by or accompanied by an economic recession. The numbers did not say a recession was on the horizon, and that's why we looked at it as a correction, and that's also why, in my judgment, the markets performed so well, or recovered basically most of what they lost, almost all what they lost in that very difficult fourth quarter. So that's where we are now, and the question is, where do we go from here? That's the big question. And right now, the financial market variables are obviously performing much better, especially if we look at the economic variables, or the financial market variables, such as sector performance, to some extent capitalization performance. The sectors of the market that are performing well are the sectors that ordinarily perform well in an ongoing bull market. They're sending a signal that we have further to go in the current bull market. But the message of the financial markets is not unambiguous. We have some messages, or some performance metrics, if you may, that are saying you got to be a little bit on the safe side or the cautious side. So, for example, if you look at the credit markets, you look at interest rates have declined. You look at some technical details, such as the yield curve, which is very controversial, but nevertheless, if you look at the yield curve, indeed that yield curve has narrowed. That's not a good sign. When you take a look at quality spreads, the difference between the The yield, for example, on a BAA bond and a 10-year Treasury, it's opened up or widened as investors become concerned about prospects for the economy. But generally speaking, on balance, I'd have to say that the message of the financial markets collectively is that it looks as though we may have further to go, maybe not a lot further to go in the current stock market economic interest rate cycle. You look at the other variables, the monetary and economic variables, clearly things have changed there. The Federal Reserve has changed, done a very, very significant, I guess the word now is pivot or change in policy. They've more or less sent a signal, not a guarantee, but a signal that they're not going to raise interest rates anytime soon, that they may not raise interest rates at all in 2019, and that's changed our view as to what's going to happen in the credit markets or what's going to happen to interest rates, and that, of course, has an impact on stock prices because one of the big challenges for the stock market always is the level of interest rates. Interest rates will at some point get too high for the stock market. In other words, earnings will not be strong enough to offset the bad news of rising interest rates. Our view right now, if we put it all together, is that we may have further to go, not a lot further to go in the current stock market economic interest rate cycle, and that's why we're maintaining a meaningful, not all the way, but a meaningful exposure to equities in balanced portfolios. Believe me, we're on our toes. We know how important preserving capital is, or being able to preserve capital in difficult times in bear markets is, to providing you with not only protection, sleep at night protection, but also good performance over long periods of time. So we're looking very carefully at all those signs or signals that tell us when we may be at or even near the end of the current stock market economic interest rate cycle. We see some signs, but they're not overwhelming signs. They're not the kinds of signs that tell us we've got to change portfolios right now. If I were to guess, if I really work hard, I crunch the numbers, I'm looking at the second quarter of 2020. That's when we might hit the wall, so to speak, or that interest rates might get to a level which are simply too high given the growth rate or the level of earnings, that it just won't work anymore. That's a guess. That's certainly not a forecast, because it'd be very grandiose of me to say that I could tell you when the end of the current cycle is coming. Look, trees don't grow to the sky. We know that. We know that this cycle will end at some time, and we know that the pressure will be on us to continue to do good work for you, to try to do as best we can to identify stock market peaks and to take steps to preserve capital or to move towards defense under those conditions. But right now, we look like we have further to go, maybe not a lot further to go in the current cycle. There are lots of things that are facing this, challenges, shall we say, facing the financial markets here, but around the world. We know that the economy in China is slowing. We know that the economy of Europe is slowing. Perhaps the problems that face Europe are much more significant than the problems, as deep as they are, that are facing China. Those are important export destinations for the U.S., for U.S. companies, and so therefore that creates a challenge. We know that Brexit's a real challenge. We know we're coming up on the election in 2020. It's important for the Trump administration to try to reach a deal, an agreement with China to avoid sort of an escalation in trade wars or the trade tariffs that exist now between China and the U.S. We think that agreement is going to be reached, but we can't be sure of that. The negotiations are long and hard and tough. Bob Lighthizer, the U.S. Trade Representative, is a tough guy, and he's handling those negotiations. My judgment, he's handling those negotiations extremely well. But they're tough negotiations. We don't know how they're going to turn out, but you can bet that the Trump administration would like to see them turn out on the positive side of the ledger, because that'll certainly help him as we approach 2020 elections. These are tough times. There's a lot of challenges that face us, but nevertheless, if we pay close attention to the performance of the financial markets, close attention to the performance of important monetary and economic variables, particularly those leading indicators of the economy, we think that we're going to be able to make good decisions for you and preserve capital. As always, I invite you to give me a call. I love hearing your not only your comments and thoughts, your thoughts about what's going on in this world of ours, but also your concerns and questions. So give me a call. Give anybody on the team here a call, Dan Nolan, all the rest of us. We really look forward to hearing from you. You're very, very important to us, and we certainly, as always, very much appreciate the confidence you've shown in us and continue to show in us. So thanks very much. Look forward to talking to you. If you get the chance, give me a call. And if not, we'll be up to bat with another Market Minute, hopefully within the next 30 and certainly not any longer than 60 days. Thanks again for your confidence.